How Index Universal Life works. First, a review. We have two choices for our retirement money, taxed and tax advantaged. How is money made in an Index Universal Life policy? Your money participates in an index. You have a floor of 0 and, depending on the strategy, a cap on your earnings. To understand how it works, watch Your Money, Your Retirement in this YouTube series. Here's a screenshot. So how does Index Universal Life, or IUL, work? Well, first of all, it is life insurance. There is a death benefit. You pay your premiums and you earn interest from the index. And like any financial product, there are costs. This is where you pay the cost of insurance and fees. And here you're watching your money grow as you're paying in your premiums and earning interest from the index. Well, when it becomes time to retire, you stop paying the premiums and you start taking your tax-free loans. So how do tax-free loans work? You borrow the money from the cash value of the policy, but you still earn interest on the money while it's in your pocket. For example, say you earned 7% interest from the index you chose. You have a fixed 5% interest rate on the money you borrowed. You are earning 2% on money that is still in the policy, but you have the tax-free use of it. Earning money from the difference between interest income and interest paid on the loan is called arbitrage. I know I won't earn a negative amount since it's in an index strategy, but what if the index brings in only 3%? Or what about a down year of 0%? I'm glad you asked. Say you earned 3% interest from the index you chose. You have a fixed 5% interest rate on the money you borrowed. You will pay 2% interest through the cash value of the policy. Now say you earned 0% interest. So you subtract the 5% and you will pay 5% interest through the cash value of the policy. Many people believe that it's a matter of time before loan interest rates go up. For your retirement income, a fixed loan interest rate is safer, especially since for most people we are looking at long-term, 15 to 20 years before borrowing yearly amounts for retirement. So what is the chance of averaging 7% over the next 15 years on my index income? Well, you have a better chance of making a decent retirement income by being consistent and allowing your money to grow 15 to 20 plus years. Here you could see averages from rolling periods of time for the Barclays U.S. Dynamic Balance Index annual point-to-point. So in the 5-year rolling period, it averaged 7%, 71.16% of the time. In a 10-year rolling period, it averaged 7%, 80.02% of the time. And in a 15-year period, it averaged 7%, 92.28% of the time. No one can tell you exactly how much your policy is going to earn. But as you can see, the averages for long-term growth are on your side. Well, after listening to this, I know you want to learn more. Learn what's available for you. Find out if Index Universal Life is a good fit for your retirement. Get your questions answered. Call me, Nanette Damasio, tax-free life retirement coach and independent life insurance agent at 702-498-2445 or email plan4@taxfreelife.us.